Welcome to Key Stock and Crypto channel. Don't forget to like and subscribe to the channel.
And guys, we had stocks down again today, and we saw yields rising. The 10-year yield hit the highest since 2008. And we know inflation is still high, so the Fed is going to keep their foot on the gas when it comes to raising rates. Now we have the CEOs preparing for a recession. And if you're listening to any of the earnings calls, then you know they're changing the forecast. Same thing they did last quarter with the Fed shrinking liquidity, and then on top of it with the 15% tax. These corporations are going to make that an excuse to do more cutbacks. But nobody's going to look at all these corporations that are doing buybacks. They refuse to put the money back into the company. They rather hand it over to the shareholders. So who do you want to be? One of the shareholders, so you can get the same benefit. Now we have the UK Prime Minister resigns, the quickest ever in history. And guys, if you want to know more information, go to my main channel, The Crypto Teacher. And don't forget, I'm doing 60-second videos on my main channel, and I'm going to start on this channel. But I want you to see how automation is going to move through the economy. Now, speaking of automation, we have Intel Mobileye targets $15.5 billion IPO. And this is an Israeli-based company. And guys, it builds chips, hardware, and software for self-driving cars. And where are we going to, guys? We're definitely going to driverless cars. I'm not your financial advisor, not financial advice. Please do your own research. But the robots, algorithms, and drones are definitely about to take over the economy. We already see automation taking over in the emerging markets. And we know they already have approval to take the steering wheel away. So if there's no steering wheel, guys, you're definitely not going to be driving. And again, speaking of driverless cars, we have Tesla missed earnings. So of course, the stock pulled back. And Tesla is just like Apple. Because we're going to start having tensions with China, they also are going to take a beating in the short term. But Tesla is well set up for the fourth industrial revolution. But guys, we know that is a few years away. Now, we also know Elon is going to be buying Twitter. The reports say that they're going to be laying off 75% of the employees. Hasn't been verified yet, but they're not going to be the only ones that are going to be cutting back over these next 2 years. Now, we had Snap stock plunge more than 25% due to revenue miss. And again, I'm not your financial advisor, not financial advice. Please do your own research, but someone is going to buy Snap. And guys, we know that Twitter and Snap are the perfect platforms for the social credit, social shopping, social working, and all of it will be in the cloud. That's the reason why cloud computing is so important. And because we know those rising tensions with China, and we keep hearing about hacks. And over these next 2 years, cybersecurity stocks will take off because we know the fourth industrial revolution is all about data. And you have to have someone to protect the data. Now, guys, we still have a railroad strike still looming. And yes, a couple of the railroads have signed an agreement, but we still have some that have not. And this deadline date is after midterms. And we know once midterms is over, they have no reason to solve anything. Now we have the Texas Attorney General sues Google over facial and voice data collection. Biometrics. Now guys, I saw a video of a guy who says he created an app that he can locate you based off of all this data that's been collected. Anywhere that picture was actually taken, he can tell you where it was at, date, and time. And biometric data is the reason why they keep pushing the digital ID. It's not just a basic license on your phone. Eventually, they're going to keep adding data in there. And then when you add in the nanotechnology, that's taking it to a whole nother level. But guys, getting over into the actual indicators, we had yields move up, we had the dollar move up, and we had the VIX slightly down. But guys, we know when yields and dollar is up, and especially yields way over that 4%, then we know that's going to hit stocks. But guys, that's all I have for you. Have a wonderful day.
In terms of credit, how should we think about what some people describe as the shadow banking system, to the degree that some people worry about not just a soft landing, but a severe recession? And I don't know if you're in the Jamie Dimon camp that equities could fall another 20% or whatnot. But the folks that really worry about stuff, they say, you know what, I'm not worried about the banks, but I'm worried about everybody else. Should we be?
I don't think so. It doesn't mean that there may not be more defaults in the future as the Fed takes rates up and the economy slows. But if you think about private credit, it's generally, if you think about our non-traded BDC, it's 1 times leveraged versus financial institutions that are 12 to 15 times leveraged. They're generally standalone entities, not part of a much larger financial system where there's any sort of systemic risk. And if you think about these entities, they're not in a distribution business. So they make a loan to a company, they hold that loan. We think that's a very good model. And today, as the banking system has locked up a bit, as the capital markets have locked up, the idea that we have a robust private credit system in the United States, I think it's very helpful to the economy. We view it as a positive for the system.
And then finally, real quick, on assets you do hold and own that you were thinking about selling, do you say to yourself, I got to hang on longer? Do you think you sell in the next year? How does it look?
In general, when you get to this kind of environment with a high degree of uncertainty, you tend to pause a bit when it comes to dispositions. Now, we saw a window in July and August where the markets were better. We exited some private positions, some public positions. But right now, when volatility is high, you tend to be a little more patient. The good news is, with our model, we're not a forced seller. And so we can pick our moments. And at some point, the sun comes back out and you exit some of these really great businesses and assets we own.
The home just keeps getting more expensive. Mortgage rates have hit their highest level in a couple of decades, according to Mortgage News Daily. The average rate for a 30-year fixed, now 7.4. Just a year ago, it was 3%. CBC's real estate correspondent Diana Olick's with us. This change happened so fast.
Yeah, it did, Shep. The market went from red hot to ice cold in just a matter of months. We got the read today on sales of previously owned homes in September. They dropped to the lowest level in a decade, down almost 24% from a year ago. And prices are still higher than they were last year, up over 8%, but they are starting to cool down. It's all because of those sharply higher interest rates. Just to put it in perspective, if you're buying a $400,000 home with 20% down and you're using a 30-year fixed, your monthly payment is now almost $900 a month more than it would have been just back in January, Shep.
Incredible. So what should home buyers, wannabes out there do if they still want to get in?
Well, a lot more are now considering a different type of mortgage, an adjustable rate loan. It's called an ARM. It offers a lower interest rate. Only about 3% of mortgage demand in January was for ARMs. Now that's up to 13% of mortgage applications for buyers. Those are for ARMs. Now, they are considered riskier, but they can be fixed rate for up to 10 years and really work well if that's how long you expect to be in the home, Shep.
We've talked a lot.